Welcome to the Deep Dive. We're here to really unpack complex topics, give you that clear, well-informed perspective you need. And today, we're diving into Linkhome Holdings, Inc., ticker LHAI. You've probably heard the name, lots of buzz, especially with that recent IPO. Our mission here for you is simple. Cut through the noise, understand what Linkhome actually does, look hard at those AI claims, see how they stack up against giants like Opendoor, and, pinpoint the real positives and negatives.
Yeah, it's a really fascinating one, that extreme volatility right after the IPO, plus these, incredibly ambitious claims. It definitely makes you think hard about how we evaluate these early-stage prop tech companies. What does disruptive even mean here?
Okay, let's peel back those layers then. Linkhome presents itself as this AI powerhouse, right? Promising faster, better, more cost-effective real estate through home GPT. But when we started digging into the core business, what's really under the hood? Is it all tech?
Well, that's the interesting part. They talk AI, they talk tech disruption, but their main revenue stream tells a different story. Their cash offer product, that's basically an iBuyer model, pure and simple.
An iBuyer. So they're actually buying homes themselves.
Exactly. Linkhome buys homes directly for cash, holds them, and then resells them. It's not just software. It's capital intensive, very capital intensive, and it puts them right in the line of fire for real estate market risks.
Right. So they are buying and selling homes. But they also mention other things, agency commissions, property management, renovation, mortgage referrals. Are those significant or just extras?
That's a great question. We looked at their filings, fiscal year ending December 2024, and the numbers are pretty stark. That cash offer iBuying segment, 86.25% of their total revenue.
86%, wow.
Yeah, $6.57 million out of $7.62 million total. So despite listing other services, make no mistake, Linkhome is fundamentally an iBuyer right now. And knowing that is, crucial when we start looking at those huge growth claims they've made.
Yes, the growth claims. They've been pretty extraordinary, haven't they? We've seen things like over $10 million in Q2 2025, over 2,900% revenue increase since 2021. Revenue up 400% versus 2024. Sounds explosive.
It sounds explosive, but this is exactly where we need to slow down and, check the receipts, go to the official documents. So that over $10 million in Q2 2025 claim, we couldn't find any official filing, any press release to back that up, nothing. Their IPO was July 24th, 2025. That's Q3. So a Q2 number like that should have been filed before the IPO. Right now, it's just speculation.
Okay, unsubstantiated. What about the 2,900% increase since 2021?
Mathematically possible, maybe, but they only started operations in July 2021. There's no full year 2021 data in the filings. Growing from almost zero always gives you these huge percentages. It looks impressive, but it doesn't tell you much about sustainable organic growth, does it? It can be misleading.
Right, context matters. But the one that really stands out is revenue up 400% versus 2024. That seems more concrete. Is that one real?
That one is verifiable, yes. But with a really important clarification, it's specifically comparing Q1 2025 revenue to Q1 2024 revenue.
Just one quarter.
Exactly. Revenue jumped from $1.14 million in Q1 24 to $5.71 million in Q1 25. That is a 399% increase, but it's a quarterly jump, not a projection for the whole year 2025 versus 2024. That's a key difference. And while we're on numbers, we saw some other figures floating around, like a trailing 12-month revenue of $4.69 million. Those are just wrong. The official SEC filings show TTM revenue as of March 31st, 2025 was $12.18 million. Bottom line, always check the official filings.
Okay, so the growth is real for that quarter, but maybe not the whole story.
Yeah.
And you mentioned digging deeper. What else did the filings reveal about that growth?
This is, I think, one of the most critical pieces, related party transactions, insider.
Oh, how significant was that?
Very significant. In fiscal year 2023, a whopping 77% of Linkhome's total revenue came from just one insider, Hai Ma, who owns over 12% of the company.
77% from one person.
Yep. And that pattern continued into 2024. More deals, property purchases, sales, commissions involving Hai Ma and also the CFO, Na Li. But then Q1 2025. A dramatic change. Revenue from related parties just plummeted, down to about $97,000 from over $924,000 in Q1 of the previous year.
Wow. So their early growth was heavily driven by insiders buying and selling property through the company. What does that shift imply now?
It's a double-edged sword, really. On one hand, maybe it's good, a sign they're diversifying, finding real customers. But on the other hand, it seriously challenges that organic, hyper-growth story. It suggests the previous growth wasn't really market-driven, but more subsidized by insiders. Now, the big question is, can they replace that insider revenue with genuine third-party business at scale? That's a totally different challenge.
Right. And speaking of challenges, for a company growing its top line so fast, even if insider-driven initially, what about the bottom line, profitability, and their cash situation?
Okay, profitability. Fiscal year 2024, they actually posted a net income of $778,236 on that $7.62 million revenue. That's about a 10.2% net margin. Not bad, actually.
10%, okay.
But then Q1 2025, when revenue jumped up to $5.71 million, net income dropped way down, just $80,629.
$80,000 on nearly $6 million in revenue.
Yeah, that's a net profit margin of only about 1.4%, a huge compression.
What does that suggest?
It could mean a couple of things. Maybe the iBuyer model is just less profitable when you're dealing with regular folks in the market, not insiders. Or maybe their costs are scaling up much faster than their revenue as they try to grow. Either way, it's a worrying trend.
And you mentioned their cash situation earlier. For an iBuyer, that sounds critical.
It is critically lean, the IPO. It raised less than $6 million after expenses. And before that IPO, as of March 31st this year, they had only $709,143 in cash.
$700,000.
Yeah.
To buy houses.
Exactly. For a company whose core business is buying houses, especially in pricey Southern California where they operate, that's just nowhere near enough to fund a meaningful inventory. It's a major, major capital constraint right out of the gate.
Okay, so financials are tight, growth questions. Let's pivot to the tech. Their whole value proposition seems built on this AI home GPT.
Yeah.
How real is that tech advantage? Is it a genuine moat?
So Home GPT, they say, uses generative AI for pricing, bidding advice, automating contracts. Their CTO, Young Gao, has a background from UC Irvine, experience with big AI models like OpenAI, Llama 2, Grok. Sounds impressive.
But is it unique? Does it actually work better?
That's the million-dollar question, isn't it? Critically assessed the functionalities they describe. They aren't really unique. Zillow's had its Zestimate forever. Lots of companies offer automated valuation tools, contract tools. Linkhome hasn't shown any hard data, any quantifiable metrics proving their AI is actually superior, that it prices homes better or more efficiently. And while the CTO has general AI experience, there's no specific mention of deep expertise in, say, real estate data science, which is a very specialized field.
So the moat might be shallower than advertised.
It feels more like a marketing narrative right now than a proven defensible tech advantage. For investors, that means the whole AI disruption thesis. It's largely unproven. It carries significant risk.
And sticking with their main business, the cash offer iBuyer model, you said it's high risk. Can you elaborate on why, especially given what we've seen happen to others?
It's inherently risky, yeah. They buy homes for cash, hold them, maybe do some light renovation, then resell them. They charge fees 1-2% to buyers, 5% to sellers for the flash sale. Historically, the money to buy these homes came from the CEO and shareholders. Now, the IPO money is supposed to help expand this.
But what are the specific risks involved in that?
Think about it. They're directly exposed to housing market swings. If prices drop while they hold inventory, they lose money. They have carrying costs, taxes, insurance, utilities for every day they own a property. Renovation costs can balloon. And fundamentally, there's the risk they just can't resell the homes quickly or profitably enough. It demands incredibly accurate pricing and super efficient operations.
We've seen this movie before, haven't we?
We have. The big one is Zillow. Zillow offers. They had vast amounts of data, huge brand recognition, tons of resources, and they shut down their iBuyer division in 2021. Took massive losses. Why? Because they admitted they just couldn't accurately predict housing prices at scale to make it profitable.
So Linkhome is basically trying the exact same high-risk strategy
that a much larger, more data-rich company failed at, exactly, but with far less capital and arguably unproven pricing tech. It's a really tough path they've chosen.
That's a sobering comparison. And for a company that talks so much about being a leading AI-powered platform, what about just their basic website, their digital front door?
Yeah, this was concerning. There were reports around the IPO time of their main website being non-functional, looking unprofessional, even placeholder text, lorem ipsum on their investor relations page.
Seriously? Lorem ipsum.
Seriously. For a tech company, especially one going public and claiming AI leadership, that's not just a small mistake, it's a bit of a red flag. It raises questions about their basic technical competence and operational readiness.
Definitely doesn't scream cutting-edge tech. Okay, let's zoom out. How does little Linkhome compare to the established giants?
Yeah.
Opendoor, Zillow.
Compared to Opendoor, they're direct competitors in the iBuyer space. Similar service, similar fees, around 5%. But the difference is just scale.
Oh.
Opendoor is a multi-billion-dollar operation, huge market presence, massive access to capital to buy homes. Linkhome is, well, tiny in comparison. It's David versus Goliath, but Goliath has way more cash.
And versus Zillow.
Well, Zillow now runs a marketplace and advertising model, which is much lower risk than iBuying. The key comparison is that Zillow tried iBuying and failed. So Linkhome is attempting something Zillow, with all its advantages, couldn't make work. It really highlights the risk Linkhome is taking on.
Okay. And what about their plans to grow? They're
Right.
mostly in Southern California now, but they talk about going national, right?
Right. Their stated strategy is super ambitious. Expand across the USA, launch in dozens of cities. The IPO documents say some proceeds are for this.
But can they actually fund that?
Okay.
The capital they have.
That's the huge disconnect. That roughly $6 million net from the IPO, it's nowhere near enough to launch the capital-heavy iBuyer model in even one or two new major cities, let alone dozens.
So what does that mean practically?
It strongly suggests one of three things will happen. Either they drastically slow down or abandon those expansion plans, or, much more likely, they'll need to raise a lot more money soon.
Which means potential dilution for existing shareholders.
Exactly. Significant future capital raises seem almost inevitable if they want to pursue that national iBuyer strategy.
Got it. Now, for anyone looking at this as an investment, the corporate structure, the governance, that stuff is crucial, especially for a new IPO where ownership is concentrated. What did you find there?
Okay, the IPO itself. July 24, 2025. 1.5 million shares offered at $4 each, raising $6 million before expenses. But the really key detail for understanding that crazy price volatility, only those 1.5 million shares are actually trading publicly. That's the public float.
And how much of the company is that?
It's tiny, about 9.4% of the total shares outstanding.
Less than 10%.
Yes, an extremely low float. And that's the main technical reason, not fundamentals, for those wild price swings you might have seen. Think of it like this. Very few shares available to trade means even a small amount of buying or selling pressure can move the price dramatically up or down. It creates squeeze potential detached from the company's actual performance.
That makes sense. It explains the disconnect between price action and, well, everything we've just discussed. What about the governance structure itself? Who's in control?
This is another major point. Linkhome qualifies as a controlled company. The CEO, Zen Kin, and his spouse, the CFO, Na Li, together own a majority of the voting power, somewhere between 54% and 60% before the IPO.
And what does controlled company mean for shareholders?
It means Linkhome is exempt from certain NASDAQ governance rules that usually protect minority shareholders. Things like needing a majority independent board of directors or having independent compensation and nominating committees. So power is very concentrated with the CEO and CFO. Public shareholders have limited influence.
That sounds like a risk factor. There have also been some whispers or allegations online about it being a scam. What's the official take?
Well, there's no direct management rebuttal in the documents we reviewed. But it's important to state facts. Linkhome is a U.S. company. It's subject to SEC reporting. It has audited financials. It completed a firm commitment IPO with an underwriter. However, that controlled status, the history of large insider transactions, the low float volatility, those factors can understandably fuel skepticism and concern for some investors.
And the team leading this, CEO, CFO, CTO, what's their track record for something this ambitious?
The CEO and CFO were previously at a company called USA Bestway Group, Inc. Both have master's degrees from UC Irvine, as does the CTO, Yuan Gao, who has that general AI background. What's perhaps missing, or at least not detailed in the sources, is specific experience in scaling a public tech company to national prominence, or deep experience managing large-scale real estate operations like an iBuyer model requires. Evaluating their track record for this specific venture is therefore challenging. Also worth noting, there's a standard 180-day lockup period after the IPO. Insiders can't sell their shares during this time. Investors should definitely watch what happens when that lockup expires. It could potentially bring more shares onto the market.
Okay, wow. We've covered a lot. So boiling it all down, what does this mean for you, our listener, looking at Linkhome Holdings? What are the absolute key risks?
You're looking at a confluence of significant risks. Let's summarize. 1, market risk. Highly exposed to housing market cycles, interest rates, very vulnerable. 2, operational and execution risk. The iBuyer model itself is tough, low margin, complex. Zillow's failure is a huge cautionary tale here. Can Linkhome execute where others failed? 3. Capital risk. This is acute. They are severely undercapitalized for their big expansion plans. Future dilution seems highly probable, if not certain. 4. Governance risk. It's a controlled company. Power is concentrated. Minority shareholders have limited sway, risk of insider-focused decisions. And 5. Technology risk. That core home GPT AI advantage, it's unproven. If it's not truly superior, a big part of the investment case just evaporates.
And you mentioned the valuation seems disconnected.
Absolutely. IPO market cap was $64 million. It surged way past $130 million shortly after. That surge wasn't driven by fundamentals changing overnight. It was almost certainly driven by those low float dynamics we talked about, scarcity pushing up the price. For an iBuyer business model, those price-to-sales multiples look very, very aggressive.
So if you want to track actual progress, not just stock price noise, what should you be watching? What are the real key performance indicators, the KPIs?
Great question. Ignore the daily stock chart for a bit. Focus on the fundamentals. First, transaction volume and mix. How many homes are they actually buying and selling? And crucially, what percentage is iBuyer versus their traditional agency business? Second, gross margin per home. Are they actually making money on each house they flip? This is key for iBuyer profitability. Third, inventory turn rate. How fast are they selling the homes they buy? Faster is generally better, lower carrying costs. Fourth, cash burn rate. How quickly are they spending their limited cash? This tells you how long they have until they must raise more money. And maybe most importantly, growth in non-insider revenue. Are they actually attracting and serving real arm's-length customers? That's the ultimate test of market adoption.
Linkhome paints a picture of being a one-stop shop for real estate, using AI to revolutionize the whole experience. It's a compelling vision.
It is a common vision in PropTech. Many companies want that. But the gap between vision and execution is huge. For Linkhome, executing that vision with their current capital constraints, facing intense competition, and navigating those governance risks, that's the monumental hurdle. Honestly, the most critical thing for them in the near term, it's securing more growth capital. Simple as that. Without a significant cash injection, those big ambitions seem very difficult to achieve.
So here's a final thought for you to consider. Given the massive challenges of the iBuyer model and Linkhome's tight capital situation, what specific strategic move do you think they have to make in the next year and a half to actually prove they can be the disruptor they claim to be? And which one of those KPIs we just listed would you watch most closely to see if they're succeeding? That's your deep dive for today.